Kitco Mining's special coverage of the Rural Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.
Has the Fed won its fight with inflation? Hello and welcome to Kitco Mining at the Rural Symposium in Boca Raton, Florida, with me, Paul Harris. This morning we're joined by Dr. Nomi Prins, a geo-macro economist and author of Permanent Distortion and other books. Nomi, welcome to Kitco.
Thank you so much. Great to be sitting down here with you.
Well, thank you. I really enjoyed your presentation the other day, and it's a good week to be having this kind of conference. The US Federal Reserve approved a quarter-point rate increase yesterday that takes interest rates to the highest level in more than 22 years. This was largely anticipated by the markets, but the question is the Fed pivoting now?
So I've looked at the Fed pivot as a three-step process. So that basically meant that we went from a reduction in the pace and the size of rate hikes, which happened in December, and we are at the stage 2 of that pivot, which is rate neutrality. They did do a pause on rate hikes last FOMC meeting, and this one they moved rates up by 25 basis points. To me, that was not a data-dependent decision. Because what we have seen, and what Federal Reserve Chairman Jerome Powell did say, is that we have seen inflation come down. In fact, the June CPI print was at 3%, which is not miles away from the target 2% of the Fed. Now, the Fed is not actually in control of lots of kinds of inflation. It cannot control the supply of food or the supply of oil or the supply of gold, for that matter. So what it did was focus on the employment report and say, well, the job sector is still hot. Well, the last jobs report had an increase in jobs specifically in the service sector, which always increases in the summer months. So I believe what the Fed did was it was a kind of a punctuation point. So to me, we are still in stage 2 of their overall pivot, which includes 3 stages, which will ultimately be rate cuts next year. And so the fact that they raised rates by 25 basis points this week, to me, is a vanity, an ego, a punctuation, we're still in control of things type of movement. It doesn't change, even though we're at higher level now in the target Fed's fund rate, it doesn't change what's actually happening in monetary policy, which is that we are gaining and have now certainty in the cost of money. And that means we have certainty in the value of other investments relative to that money, and as a result, we're seeing and we'll continue to see less volatility in the markets. And that's what I think we all need to focus on at this point.
I think the whole process has been quite interesting because over and above the sort of, let's say, the hard data, which is the rate increases or not, there's been a lot of messaging what we may or may not do depending on what happens or does not happen all through this process, keeping people guessing, I guess.
Right. And I think that's the point that we're at right now, because you're right. That's sort of keeping people guessing. How much is the Fed really going to raise? All the larger increases that we've seen over this past 14, 15 months, all of that has kept investors and the markets on edge. Markets like to know how much money is going to cost. They like to know where it's going to come from and what it's going to be able to accumulate on itself as a return as it's invested in different commodities and different stocks and so forth. And I think right now we are at that point where we have to literally ignore the noise of the Fed. Now, that does not mean we all will. We're here talking about it. But we're at a point where whatever the Fed does or doesn't do with another potentially cosmetic rate hike or not, or if it's really not going to be as data dependent as it said it would be or not, is that we have a plateau on the cost of money. And I think as investors, what that means is we've got a perfect opportunity to use cash that has been on the side, and that there are trillions of dollars worth of that, and to deploy it in the places in terms of investment opportunities where it's going to grow from this point on, and not worry about what the Fed's going to do. Because again, it could raise a bit or not, but we are in stage 2. We're in a period of overall rate neutrality or that sort of pause period, and the next stage will ultimately be a rate decline. And so positioning for all of this is what we really have to do now as investors.
Okay. The timing of a rate decline is obviously now, I imagine, front and center of people's mindsets and where they're thinking, where they're sort of doing their calculations and their modeling. It's interesting to use the word plateau because a number of speakers at this event have said that, higher for longer really is an untenable position due to the rapid rise in interest payments accruing on the US debt. One of the speakers said, it's going to be $1 trillion a year this year, 1% of GDP. So that's obviously unsustainable.
Right, I said that. No, but the point is, yes, and this is why we're looking at a plateau, and why, as investors, we need to look at where this is going to lead us from this moment on, whether or not there's an incremental rate hike again or not, and ignore literally what the Fed is saying at this point, and work towards maximizing those returns. Because you are right. The debt that we have accumulated as a country, and this is after a dramatic back and forth within the halls of Washington between the President, Speaker of the House, about whether or not we should raise the debt ceiling, which is always raised after every single dramatic period. But it's just a little pain along the way, and we all sort of watch it with just kind of cringy kind of attitudes. But then it happens, and now we have a 2-year period where there is no debt ceiling, right? So not only have we had historic, at least over the past 20 years, payments for our interest because of two things. One, we have more debt, and two, we have higher rates. So on a historic basis, those two maths equal a significant percentage of GDP, 1% of GDP. When GDP is only forecast to increase by 1%, maybe 1.5%, depending on just some momentum in the general overall economy, is actually really, really bad. We are effectively paying to stay even. So even all this talk about whether there's economic growth or recession or whatever, we have to take off the table the fact that the first almost $1 trillion of that is actually just going to sustain the amount of debt we have, and it's also personal debt. So according to the New York Fed, we are also at record high levels of consumer debt. That's credit card debt, which is also and it's always very high in terms of interest rates. You should always watch which credit card you use, but which are also, because of these higher rate periods from the Fed, at higher historic rates. So we have so much debt in the system. And again, that is why at this pause period, at this plateau period, wherever it is we go from here, whenever we do, I think it's going to be mid-2024 that we do start to see cuts. But whenever we do see them, we need to be prepared for that, because we are in a period where you actually have time to make those really strategic investments in gold, in silver, in copper, in commodities, in specific individual mining stocks and other forms of energy stocks and so forth, that are going to sustain through this period and allow investors to be positioned for when we do see those rate cuts that will come.
Okay. I want to ask you one more question on sort of macroeconomics before we start talking about stocks and gold and things of that nature. Two of the economic terms that are very much in the news stream, the news flow at the moment: inflation and recession. Is inflation busted? Are we going into recession?
So again, I think that we have gotten complacent about how we look at inflation, and this is because of this watching the Fed and their conversations about macro inflation numbers like CPI, which they do look at to calibrate their target inflation. That is a fact. But what we will continue to see is inflation in certain components of the market. We are seeing inflation, for example, in wheat and grain prices because of geopolitical events that are happening because of Russia's invasion in Ukraine, and conversations that are going there with getting some of those on-the-ground resources out. And we are seeing orange juice inflation. We will see, I believe, inflation in energy prices again, particularly natural gas prices, because we've seen such record high heats, and we don't have the reserves and storage that we thought we had because our winter was mild going into potentially next winter. So we're going to see spots of inflation, but I think we have to recalibrate how we look at inflation. Again, tune out the Fed's view of inflation and consider where those prices are increasing as, yes, places where inflation will be felt. So I do see that. In terms of how that relates to overall economy or a recession, well, with what the Fed said, with what the IMF is saying, with what sort of the general economic ethos is predicting based on information and data, is we are going for developed countries anyway, for G7 type countries, for the US, into a period of nominal growth. And if you take out debt and if you take out some of the effects of inflation, it is actually negative, but that's not how we define the math of recessions. So I do think we could see a mild recession, even though we are also hearing and talking about the soft landing of the economy that the Fed has magically engineered. The reality is there have been some supply and demand convergences that have happened in the same time period that the Fed has been raising rates, but that the Fed has raising rates but has had no control over. So that's going to continue in the background. So I do think we'll see a mild recession. I do think that will ultimately move us towards those rate hikes as well, and the Fed sort of backing off. I think we'll also continue to see these periodic and specific inflation points, particularly in certain commodities along the way, that have use value. And so I think both of those two things are going to be happening at the same time. And in addition, there will be parts of the economy that are going to see explosive growth as well. If we take a look at the manufacturing sector of the United States, the amount of factory new construction that has happened in just the last year alone is double in total what it was the prior year. In just April alone, it is 3 or 4 times the amount of any other April that we have seen on the last 5-10 years on record. So there is a tremendous amount of building, predominantly for manufacturing, for chips, for energy resources, for energy efficiencies. That's a matter of national defense and so forth. That is a growth area. So we're in this really interesting time where we can have all of these things happening at once.
There does seem to be a lot of, should we say, counterintuitive things happening. Despite the fact we may or may not be heading towards a recession, there's been a resurgence in stocks this year, general equities. The setup for commodities is really good and strong, but it hasn't really happened yet. It's perhaps been overshadowed by this rise in the strength in the sort of general equities. When do you think maybe the commodities and natural resource sector will start getting the upper hand again?
Yeah, so what's interesting, and this is where looking at specific areas comes into play. For example, if we look at the price of tin, which is kind of not a really exciting, exotic, we talk about it a lot, commodities, but it's increased by 60% since November. It's increased the prices since 40% just over the last few months. So there are points that have been increasing. Gold has increased by 15% since a year ago, but yes, it's in a kind of plateau stage as well, with the sort of what is the Fed going to do conversation or not do in the background. But I think we're breaking out of that for what we were talking about before. You reach a pause, you reach a plateau, and all the sort of waiting amounts of money that are on the side are like, okay, well, now what do we do, and now how do we get positioned for much more certainty as to the cost of money, as to the path of rates going forward. We don't know when it's going to happen, but we know we're not going to see 75 basis point hikes, right? So there's more certainty around that. And that gives commodities an incredibly good state to really enter into their own. You know, we've seen gold hold its own after increasing. We've seen gold relative to other currencies, like the Chinese yuan, actually raise by more than it is relative to the dollar. Why? Because the dollar had stayed strong for a while. But now what we're seeing is the dollar has been backing off relative to gold, relative to other currencies, and that creates another sort of pocket of opportunity for commodities, right? So we're not worried about money pouring into the dollar because rates are going up. We're thinking about money going out and finding commodities that can hold their wealth and value. So we're seeing that in gold, and I believe we're going to continue to see that in gold. I think we could see gold prices absolutely at 3,000 or so within the next year, 3,500 by the end of 2024, as we start to see these rate cuts also come in. We're seeing copper turn back around. We're seeing tremendous new interest in silver, which has also been kind of, so the background to gold, but silver is a use value. So you couple to all of what we're talking about, the energy transition that's actually happening, our need as a globe for more independent sources of more reliable energy, and also more reliable commodities to basically power that energy. And we're going to see upsides in uranium. We're going to see upsides for nuclear power. We're going to see upsides in lithium and zinc and cobalt and manganese and all the things that we're talking about just related to EVs. But not only are they related to EVs, now they're going to be related to military defense and geopolitical power and national security.
I wanted to ask you specifically about that, Nomi, because it's not just the invisible hand of the market that's guiding these things. In your talk, you mentioned national defense, commodity turf battles, and the changing nature of how we as a society, in North America particularly, fund the production and extraction of natural resources. And you said, maybe with a hint of cynicism, maybe humor, I can't recall, that if Washington wants to pass legislation quickly, it tacks something on to do with DOD, Department of Defense.
Right.
How do you see that sort of playing out in terms of the natural resource sector?
So the Department of Defense has recognized slowly, but over the past few years, that it needs to really stockpile. And there was a defense bill last year that was passed where the Department of Defense now has the authority to stockpile critical defense minerals as well as rare earth minerals. Why? Because we need it to power our military. And also, as you mentioned, I've mentioned a lot, if there's bipartisan agreement on something in Congress, which there is on anything that is military, and the Department of Justice and Pentagon wants to fund it as well. Well, that's two sources of funding coming into that space. So in the critical element space, in the rare earth space, in the uranium, in the nuclear space, these are all areas where the Department of Defense wants to have the United States be more independent. What does that mean? It means China has had and still has a tremendous amount of these resources, of criticals, of rare earths in its purview. And with its neighboring countries. And the United States wants a piece of that. So what we've seen really rapidly in the last couple of years is more and more legislation being introduced on top of what the Department of Defense is doing to create momentum in this. And the politicians are sort of creatures of we want to stay in office. And so if they see on both sides of the aisle that there's a body that's always around, like when we were talking about the debt ceiling drama in Washington, nobody touched the defense budget. Nobody touches something called the NDAA, which is the National Defense Authorization Act. And so that is where all of the politicians are basically putting their legislation or pieces of the same words of their legislation in the resources space. And that's going to continue to happen. And that is on top of the Bipartisan Infrastructure Act, the Inflation Reduction Act, the CHIPS Act, all these other acts that have collectively opened the doors for $2 trillion in totals worth of government money and subsidies and tax breaks. You add that all together. That's why we're seeing a factory boom in the energy space. That's why we're seeing more domestic production, excavation, alliances with the world outside of China in this space. That's going to continue.
I think a lot of people have been pleasantly surprised at just how fast some of this is moving. The Inflation Reduction Act that you mentioned was passed last year, and already funds are being dispersed under that, so very positive there. Okay, while we were talking before coming on air, you mentioned how you're picking up that younger people, millennials, and I can't remember what the designation now is.
Gen Z.
Gen Z, okay,
Right.
Thank you. I'm a Gen Xer, so all this is beyond me. But how younger people are now starting to become interested in gold and the commodity space. What are you seeing?
Well, so there's a couple of things. One is just based on the research I've been doing, there has been a trend of millennials, of Gen Z money looking for this plateau period of opportunity. Right, so going from a lot of them who got involved in the stock market during the COVID sort of shutdown periods, and being more involved in the retail investing side, in Bitcoin substantially and seeing rises there, or some people taking some hits there. But the point being, seeing that as an alternative investment towards the status quo of the financial system, and I think that same motivation is coming into the search for commodities, and gold is it's got so many values to it. It's obviously been around for 5,000 years. It's a wealth preservation commodity. It is a precious metal. There's only so much of it in the earth. You cannot print gold. All of those things are true. But now also it is a diversifier to Wall Street, to Federal Reserve policy, to centralized government and banking policy. And so for the same reasons that Bitcoin was attractive, or just being involved in individual stock investing was more attractive than using, sort of a broker through a Wall Street firm, that same mentality is not just about to come into the gold sector. It's actually in Reddit conversations. We're seeing more podcasts develop in the space of looking at commodities from a new class and a new demographic of investors. And what that means is central banks have already had a record year buying gold for other reasons, right? The retail investor has much more potential to buy much more gold. Central banks are only 20% of the gold market. They only own 20% of the excavated gold reserves. There's a big amount of opportunity for retail to get on board with that. And if we have seen gold rise because of China, of Russia, of India, of their stockpiling gold on their own reserves, and of them talking about gold to their own populations, well, just if you multiply that out across the rest of the world, and combine it with the interest of a demographic that is involved in its own investing and looking for opportunities of preserving and growing wealth going forward, and coming to gold already, then you actually have a massive amount of money that can continue to calibrate. And not just into gold. Gold is the gateway into copper, into silver, into uranium, into lithium, into cobalt, into zinc, into all of these commodities.
I think it's fascinating that there's potentially the excitement of a new generation discovering gold. And this is a generation that's obviously very connected with social media. Yeah. Owning gold, physical gold at least, is something that perhaps is very tweetable. It's very Instagrammable. Showing the aspiration and affluence.
It's physical potentially.
Yeah. So I think it perhaps meshes very well with that.
And also but also on that, all of the ways in which you can buy gold now have just massively increased, and so the opportunity to buy gold shares across, or in miners, or pieces of gold that are reserved in a vault somewhere across the world, is more and more available from a technological, from an app standpoint, through different online applications, and so the ways to get that gold are growing and more secure than they've ever been before, as well, in tandem.
Maybe we need to get Uber Gold, where you hit your button on your app and you get an ounce delivered to you.
Or you tip them in gold.
Well,
you don't know.
The refineries deliver with an app. Okay.
I like that.
Outlook for the rest of the year. What are you looking out for? What are you looking forward to?
So just based on some of the things we've been talking about, I do see energy prices in particular parts of the energy sector rising. I think natural gas prices, for example, are way too low relative to our power grid needs, relative to the fact that the U.S. uses for 40% of electricity natural gas. We've been accumulating and storing, but that's not enough. Europe is becoming more and more required of natural gas. So I think we're going to see those prices go up. I don't think we're going to see the situation in Ukraine go down anytime soon, and that's going to just have that impact on natural gas, potentially on oil, but way less so. Definitely on food commodities. I think that's going to continue to be an area where we're going to see a lot of price increase, a lot of inflation, as we talked about before. I do think gold is going to rise. I think it's going to continue this sort of rise that it's had after the plateau that it just had, or sort of interim plateau, to another level. So I do think we're going to see that gradual increase. I think we're going to see copper. I think we're going to see silver. I think we're going to see the use commodities that are part of the energy transition, that have great conductivity properties like copper, that are going to be involved in those factory builds like steel, like concrete, like iron. All of those things are part of projects that have started and are going to continue. They're not just going to stop in their tracks, because they're also involved in the semiconductor necessity because of national defense. So I think we're going to see a lot of commodity increases and energy price increases along the way as we continue to grow those parts of the economy. And investors continue to see these as a hedge against fiat currency, against currencies that can be electronically manifested instead of actually excavated. So I'm excited about that going forward for the rest of the year.
I think it's very noticeable or palpable that there is a level of excitement here about the gold price increase that is presumably to come, the copper price increase that is just around the corner. Yeah. It's a sort of wonderful feeling, given the last couple of years have been quite depressed. Excellent. Well, Dr. Nomi Prins, thank you very much for joining us today.
Thank you so much.
And stay tuned to Kitco Mining for more from the Rural Symposium in Boca Raton, Florida.
Kitco Mining's special coverage of the Rural Symposium, Natural Resource Investing, is brought to you by G Mining Ventures.